All right, good evening, everybody. I hope you guys are doing fantastic this evening. Welcome to yet another evening, and I'm going to assume that you guys can hear me okay. I was not actually getting any responses from my moderators, but I think it's because they muted themselves. So if you guys can hear me, would you please confirm by typing into your questions panel there? All right, Edmund said he can hear me, so great. Well, you guys should be seeing the opening screen tonight, and you should be seeing all of the slides at this point, and we are moving on through our foundations of stocks and options together. Tonight we are in level 2, class number 4. Level 2, class 4. That means we've rounded it out all the way to chart patterns. And tonight specifically, we are getting into chart patterns part 2, picking up where we left off in the last class, and learning about the second type and second qualifications, or I should say second evening of the qualifications of chart patterns. Tonight, here's our agenda. We're going to do a quick review of what we discussed in the last class. Then we're going to get into continuation patterns and gaps, and that will round out our evening. We got a very full evening together tonight, so let's not waste a whole lot of time. As a quick review, you guys should remember after the last class that when we talk about patterns, we're talking in essence about the little formations of sentiment that form at what I refer to as a short-term support and resistance areas. And what these little areas do is they provide insight into how the sentiment of the people that are trading the stock feel about that trade or feel about that individual stock. In the case of an overall index, it's how they feel about the overall market. And then, of course, as the sentiment starts to hit a tipping point and it shifts, it gives us confirmation of the patterns. You can look at this example that I've got over here on the right side where the trade had run down and it started to create a bottom down here around $53, $54. We bounced initially, pulled back down into the $53, $54 range, and then we tried it yet again, third time. We bounced one more time, and on that third final attempt, we broke out. Now, why did this breakout come? And the answer is quite simple here, because the support was building, and as the more times you run into support and the more times that support holds as support, the more likely it is to turn into a reversal area in a location where the buyers are going to show up and the sellers are going to give up and finally say, hey, it's time to go higher here. So that's the nature of what chart patterns are, and you can see just from this little picture right here that you're seeing a story, literally a story of the sentiment of the people that are trading the stock during those turning points that occur on the chart here. All right, there are three qualifications or three classifications of chart patterns that I shared with you in the last class. We specifically looked at two of them, but the three classifications are reversal, consolidation, and continuation patterns. In the last class, we broke down reversal and consolidation patterns. So as a refresher really fast, these were the reversal patterns that we discussed. We looked at the V top and the V bottoms. We looked at triple tops and triple bottoms, head and shoulder patterns. We looked, of course, at the inverse head and shoulder, which is the upside down version of the head and shoulder pattern. And we looked at the double tops and double bottoms, and we discussed the line pattern. Those were the 6 reversal patterns that we discussed in the last class. And then, of course, we got into the consolidation patterns. Kind of the main formation of the consolidation pattern is the channel, and then the variations of that really take the shape of what we refer to as triangles. We have the symmetrical triangle, where the lines are collapsing somewhat evenly upon themselves. The ascending triangle, where the top resistance is holding flat, but the buying support area is consolidating and collapsing, I should say, into that resistance area. And then the descending triangle, you have the descending line on the top with that flat bottom. And then, of course, the inverse triangle looks a little bit like a megaphone as it is expanding outward. Those were the patterns that we looked at in the last class, and based on your commentary after the last class, I believe all of you felt like you understood them, and all of you felt like you learned a lot going through that material. Now tonight what we're going to do is we're going to get into a different classification. This classification is something we refer to as continuation patterns. And continuation patterns are some of my favorite patterns, partly because they're so stinking reliable. I mean, all of the patterns that I'm sharing with you are fairly reliable, meaning that most of the time they tend to play out the direction that I have shaped up for you here. But these continuation patterns, some of these are just ridiculously reliable. So we're going to look at those tonight. What is a continuation pattern? Well, in a nutshell, a continuation pattern is a small formation of a trade consolidation. Maybe you remember in the last class I told you that technically speaking, all chart patterns, no matter what their classification is, technically they're all a type of consolidation. What it is it's the shakeout of the buyers and the sellers at those areas that we refer to as pivot areas or pivot points. Now, whenever you get into certain types of formations, they turn into reversals. Even though it's a consolidation that finally gives way and turns into a reversal. Or certain ones are obviously just larger consolidation. Those are the consolidation patterns. Now, tonight what we're looking at, these are what we call continuation patterns. They're short-term consolidations where the buyers and the sellers are shaking each other out, and most of the time they turn into a continuation. So they're very, very short term. They almost always occur at or very, very close to a pivot area. If they don't occur right on a pivot area, they're very close to it. If they don't occur close to it, then in the future you can almost guarantee that wherever that pattern showed up, it will turn into a pivot area in the future. These little continuation patterns are going to occur over a very short period of time, and this is going to be the biggest difference in the consolidation and the reversal patterns that we looked at in the last class and tonight's continuation patterns. Tonight's patterns are going to be very, very quick. Some of them are going to take 2 or 3 days, and sometimes they might spread out into 8 or 10, or sometimes you'll see them for a couple weeks. That's more rare, but they're very, very short-term patterns. Most of the time, more often than not, they're going to resolve as a continuation of the preceding trend. So if the preceding trend was a bullish trend, then most of the time when you see these little patterns, they're going to turn into a continuation of the bullish trend. If it was a bearish trend, then most of the time when you see the little pattern, they're going to turn into a bearish trend continuation. All right. Continuing on here, here's the few common traits of the continuation patterns. Few common traits here. Number one, they're going to be short counter trend or sideways moves that occur during a larger trend. Short counter trend or sideways move that occurs during a larger trend. Usually they're going to occur at the minor level of the trend. Now, whenever I talk about the minor level of the trend, what am I referring to? Remember, we talked about 3 levels of the trend. We talked about the primary, intermediate, and minor levels. Well, these little continuation patterns almost always will be a minor level pattern. Just out of curiosity, what level of the trend do you think most of the consolidation and reversal patterns that we looked at in the last class, what level do you think that those particular patterns will be occurring at? Any ideas? Where do you think that those larger patterns would be occurring at? Which particular level? Primary, intermediate, or minor? Some of you are writing in primary. Most of you are saying intermediate, and you're absolutely correct. They're really intermediate level trend reversals. They're going to reverse, a 6 to 9 month trend, typically speaking. Yes, they can happen on an even grander scale, and they reverse a primary trend. But usually, certainly all the examples I think I showed you in the last class, those are going to be more the intermediate level trend reversals. So these that we're looking at tonight, these are going to be minor level. We're going even smaller as we're getting into even more detail of the patterns here. Volume during these patterns almost always diminishes, meaning it gets smaller, and then it returns on the breakout. So during the pattern itself, the volume very often will dry up almost to a halt. And you'll usually see it as kind of like a little curve. So, the volume will start like this, and then it gets smaller. See if I can draw these right. And then it gets smaller and then smaller. And then suddenly it's like, boom, volume broke out, and that was the breakout of the trend as well. So we'll look at some of those volume implications here tonight as well, see how many of those confirm the way that they should. But what you're looking for in general, it's not a hard and fast rule. You don't have to have the volume confirming the pattern, but very, very often what you'll see with these continuation patterns, you'll see the volume getting smaller and smaller, and then it busts out with the breakout of the pattern, which makes it a nice little confirmation. Usually, as I've already alluded to tonight, usually these continuation patterns are going to occur at a pivot area. Okay, those are some basic traits that all these patterns are going to have in common. Now, let's get into the first pattern. The first pattern is one of the most popular, commonly known patterns in the world of trading. It's called the flag pattern. A very common pattern. In fact, the truth of the matter is most of these continuation patterns are really variations of the flag pattern. That's the truth of it. They're kind of all very, very similar here. The flag pattern is going to occur in a sharp trend with a sharp move. And oftentimes I'd say it's a sharp directional move, meaning it's a very sharp strong directional move in the direction of the trend. Oftentimes it almost goes straight up, kind of like a flagpole. Take a look at this example that I've kind of got drawn out here, and notice how it just goes straight up, and then it kind of flies like a flag, and then it breaks out. Okay, now that's the nature of the flag pattern. The flag is going to represent a slowdown in the momentum of the trading, while the stock quickly, and there's a key word there, quickly, consolidates the buyers and the sellers. Now, how long is quickly? Well, usually it's going to be anywhere from 3 days up to 8, maybe 10 days. I usually say 3 to 8 days. So, if you want to put 10 days down there, that's fine as well. That means a couple of days up to a couple of weeks. If it's not broken out, if it's not confirmed within a couple of weeks, you might start to question it a little bit. Moreover, if it's not broken out in a couple of weeks, you know that breakout's coming sooner than later because it usually only lasts for a couple of weeks. So the longer that the little consolidation, the little pattern goes, the more likely it is to break out pretty soon. The flag is going to be characterized by a very small up and down movement, usually sloping down slightly. Take a note here. You see how my pattern is actually going downhill just a little bit? That's the nature of the flag. So it's kind of like it's flying from a flagpole. And as I've already mentioned, the volume tends to decrease during the pattern and increase on the breakout of the pattern. Just so you can take a little bit better picture here, take a look at this snapshot of a theoretical model of a flag pattern and what it looks like. And you can see how it trades basically straight up. It does a little squiggle and squaggle going sideways with a slightly downward motion, and then it turns right around and it breaks out and it goes bullish. In the case of a bearish flag, it's going to look like this right here, where it comes down and then it does the exact opposite. It goes slightly higher. So this would be a bear flag. It's the same pattern. It just so happens that this particular one is going downhill and bearish trend, does a little counter move slightly uphill, and then it continues bearish. Let's look at a few of these in practice. I've highlighted several examples for you tonight. Hopefully this will bring some clarification. You can see how short these little moves are. Take a look at this move down here in July. This whole move was about 3 or 4 days there. 1, 2, 3, 4. Broke out on the 5th day. Somehow I managed to take this picture without volume. Please forgive me for that. So we can't see the volume implications. But that's what a flag looks like. You see it had a sharp directional move up. It does a little squiggle and squaggle sideways, and then it breaks out. And you can see that it was a breakout to the upper side here. Here's another one, same stock after a larger correction here. Same stock, got going in the trend, got a little flag pattern, and then boom, we broke out. Now this one kind of rounded out until we got the next flag, and then the trend really continued following that particular movement there. So there's 3 flags on there that I've highlighted. The truth is these are so common, you can find them just all over the place. And a lot of times as we go through these charts tonight, you're probably going to see several that I didn't even highlight. And just because I didn't highlight them doesn't mean they're not a flag. In fact, I can see one right here. Here's a bear flag on here. The move had started bearish, did a little counter move, and then boom, it broke out down here. The difference here is there was a double bottom. There's your reversal pattern. Did your double bottom, and this was all part of coming back to test this old resistance as a new support. And once that had turned around, the new trend was taking over there. So, later what will happen is you'll start to blend all these patterns together. And if we have time tonight, we'll go look at some charts and kind of pull all of them together, hopefully. But that's your basic idea there of the flag pattern. Now let's take another look here. These are some bearish pictures, bearish flags. Notice the bear trend here had started way back here in March, and as it started to roll over, here's a flag that I did not mark. There it is right there. Here's a flag that I did mark, and then continue on down in the bearish trend, sharp directional move, boom, there's a little flag, breaks down. Then we had a little kind of a flat little correction here. Some might want to call that a flag. It's a larger flag for sure. Doesn't tightly fit into the little mold of the flag. But this one here certainly fits into it. And then as the stock bottoms in through here, coming into August, notice we've already got a little bull flag right in through here as well, even though the whole reversal has not taken place yet necessarily. All right, now let's come over and take a look at this particular image. This was from First Solar. And notice this one had a sharp directional move. And, by sharp, I mean, we moved from $140 a share all the way down to $110. That's a pretty sharp move. Got a little flag pattern here, broke out, got another flag, broke down, got another flag, broke down. And you can see this is like break flag, break flag, break flag. And it just continues in that fashion. And you can see Well, let's see how good some of these volume implications are. Notice how the volume had dried up substantially here during the flag, and then right here on the breakdown, volume returned. You see that right there? And then during this flag right here, volume dried up. It didn't really come back in on the breakdown like we would have. Well, it did actually. I mean, here was the real breakdown, and that's when the volume returned. And then this little flag here, notice the volume dried up, and it came right back on the day that it broke out. So you can see how that worked. Now, this one's interesting. Look at this. You had high volume going into the flag. Only 2 days of low volume on the bearish breakdown. You had good volume popping back out there. And so, you're not looking for massive volume spikes. It doesn't have to be huge volume spikes like this one way back here that I just drew an arrow at. But, just a little decline in volume, then the volume rushes back in. Decline in volume, volume rushes back in. And so what that does is it adds validity to the fact that, hey, more than just a couple of people are trading this thing. Volume is picking up, and obviously the trade is picking up as well. So there are several examples of flag patterns, complete with some volume examples. And you can see, since they're uniform, you can really see that textbook formation. It's very short, 1, 2, 3, 4, 5, 6 days, 7 days on that formation. This one was 1, 2, 3, 4, 5, 6 days. 1, 2, 3, 4, 5 days. 1, 2, 3, 4 days. 1, 2, 3, 4 days. And the fourth day it started to break down. And some days sometimes you'll see a flag that has 8 or 10 bars in there, but most of the time, this is pretty typical right here, where you have about 3 to 5 or 3 to 8 candlesticks, and then you have the flag that goes ahead and it confirms and it does the continuation. The big question people always say is, well, does that mean if it has 12 or 13 candles that it's not a flag? Well, it just means it's really big. And, you be prepared. The longer that it does not reverse, or the longer it does not continue, obviously, the higher the odds that you would have a reversal. But, this is more art than science. You don't have to be scientific about it. You don't have to sit here and say, well, it's just, specifically within this metric right here. Watch the behavior, watch how it plays out, and you'll know as you test many of these and you start to analyze them and observe them, you'll get a pretty good feel for how they play down. Now, one thing I did want to add in here, just kind of talking through it, this is really good for your notes. Whenever let's say we're in this bearish trend here, and I'll mark this up here just so there's no doubt we're talking bearish. When you get into a bearish trade, let's say that you had entered the trade bearish right up top here, and what happens with these flags is they're an opportunity for two things. Number one, they're an opportunity when you start to see them to say, hey, it's a flag. I think I will hold my trade because I think it's going to continue. You can still tighten your stops, but you can hold your trade. Number two, if you did not get in, as you get a new breakout of the flag, this is a re-entry, or it's an opportunity to add to your position. So you can add in additional shares, and then what will happen is as it trades back up, you can jump back in again. Oftentimes, they're actually trading back to or very close to the same pivot area. You can see I can almost draw a straight flat line right in through there, right around $100. And so if you're looking at it through very very analytical eyes saying, well, how far am I moving? It may not be moving a long, long way, but in reality, the course of the trend, it is actually moving quite a ways. You can see how that formation is shaping up there. And so what's really cool about these flag patterns is when you can recognize them, they create either, number one, again, confirmation that you're in the right trend so you can hold your trade, gives you some confidence there, or number two, it gives you better opportunity to jump back in if you missed the formation. Let me also just point out here, I should have made a slide for this and I did not. If you're trading a flag pattern, you see the flag shaping up, you want to enter on the break of the flag and you want to set your stop right above the flag. Okay, so let me get rid of all those lines so I can really make this even cleaner here. Enter down here on the break. This is in the case of a bearish flag. And you put your stop right at the swing high, just maybe just a few cents higher. That'll be your stop. And what's great about these little flag patterns in this particular type of a scenario is you can really get good risk reward. We haven't talked about that a whole lot yet in this program, but my veteran students that are here on retakes, they understand that terminology of risk and reward. And what's great about these little flag patterns, a lot of times we'll set these up in Power Trader, and I'll say, well, it looks like there's some sort of little corrective move, or a flag pattern. I'll use all those terminologies similarly. And what I'm saying is, as it starts to break, you can adjust those entries. Sometimes in Power Trader, we might have had an entry way down here. And then as that flag forms, you're watching it during the week and say, that's a flag, it's a flag, it's a flag. And so you can adjust those entries, get in sooner, and that's when you really get a much, much better risk reward. Just imagine you got an entry here of maybe about $100 it looks like, and maybe right up here about $105 becomes your stop. So you got an entry here of about 100, you got a 105 stop, and we don't have the chart history to verify this, but let's assume that your next target was right in through here. Even though it doesn't look like it's a long ways on the chart, turns out that was all the way down here to $85. Well, that's a $15 reward based on your entry at 100 to your target about $85. We'll assume that there was some history further to the left here. Well, that's a $5 risk for a $15 reward. That's 3 to 1. That's a really good risk-reward ratio. And so flag patterns really work well for setting up good trades, for entering into a trend once it's already done. A lot of times people say, well, is it too late to get into a trend? And oftentimes the answer is yes. But when you see a flag, the answer becomes no. This is starting to be the great time to get into the trend because you're about to have another little swing. And so it works out for you really well there. So you guys can see those basic ideas there. All right, now let's look at a variation of this. And this is a variation that we refer to as a stair-step pattern. This is a variation we refer to as a stair-step. This stair-step is similarly, it's going to occur in a strong trend with a sharp move. Basically, it's the same pattern as the flag, but there's no slope to the move. In fact, I'm going to give you a little hint. I don't care if you misname a stair step. If you want to just look at this and say, that's a flag, it's just not got a slope, I won't call you crazy. There's a lot of analysts, a lot of traders would actually refer to it that way. They would just call it a flag. And I'll be okay with that if you want to refer to it as such. But I technically refer to them as a stair-step fashion or stair-step pattern. And you're going to have similar moves. The volume is going to decrease during the pattern, and it's going to increase on the breakout of the pattern. Now, in this particular example that I've got here, I've literally stair-stepped them together. So it's kind of, it's almost like, putting a slinky down the stairs, right? We're just doink, doink, doink. Very rarely do we actually see this tight of a formation. You'll see the examples here in a moment. Sometimes we do see them this tightly, but the idea is that you've got some sort of a little short consolidation, breaks out, consolidates, breaks out, and very often they just kind of stair step along, or you might even get a mixture of the stair step, the flag, and then the next pattern I'm going to show you in just a second called a pennant pattern. Here's what it would look like in a bearish formation. You're just going downhill. You stop for a moment, trade sideways, break on down, stop for a moment, trade sideways, and continue. And so in practice, here's a couple of stair steps that you can look at. This is on Baidu. And notice here the trend has already reversed. We've already actually got a gap here, which we'll talk about later tonight. And then you've got a flat little formation here where obviously the buyers and the sellers came up with an agreement. Agreed upon price is a small trading range, $5. It's not like a channel. You cannot trade inside that. It would be impossible. Lasts 1, 2, 3, 4, 5 days, 6 days, and on the 7th day, it broke out. Okay? Where did it go? It went right to another stair step. And so now here you are 1, 2, 3, 4, 5 days into this pattern. And if this thing continues again, where do you think it's going to go? Well, let's just look to the left because here we do have some opportunity. Here's another, actually this is another pattern we're going to talk about in a moment here called a pennant. But there's another pattern. That's probably going to be your next target. And so as you trade higher here, if this pattern continues to develop as a stair step, you can just look to the left and say, wow, I had a resistance came into play here. I recognized some support right in here, recognized the support here, support for several days here, resistance here. Yeah, it makes sense. 136 is going to be a pretty good target there for that trade. And so you can see how that works there. Does that make sense to you guys? You see how it's a stair-stepping motion? The formation of this is the suggestion that this is going to continue in a trend. Does that make sense? Now, just looking left here, I can actually show you similar formations. There's another similar formation right there. Here's kind of a stair step with a rounder, more of a round bottom right there, continuing out there. Here's almost a flag pattern, a very steep one. a little bit more of a controlled one there. There's another flag pattern right there. So like I told you, these patterns are very, very common, and they're very, very accurate. They fall out, or they either break out in a bullish move or break down in a bearish move most of the time. They're very, very solid patterns to be looking for here. Here's one in the CMG trade. The truth of the matter is, on this particular picture, I took the screenshot and I pulled it into my program, and it's not as obvious. It was a lot more obvious in Trade Navigator, but I've still highlighted it for you. You can go back and look at March of 2012. You can see there's a clear stair step happen right in through here. You can see the volume drop down substantially, and on the breakout, volume came back into play right here for the first 2 days of the breakout, and you can see that the volume was above average. It doesn't really matter how big the volume is, as long as it's better than it was. That's how you know it was an increase in volume. So we're not looking for specific volume levels, just an increase in volume. Coming on up through here, you continue to trade higher in the trend, and then we got into a very flat period. Now, this was a long one. This was one of those that really went for a long time, and then it stair-stepped right up again to the next trading range. This particular picture here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days. It was on the 13th day that it broke out. So that would be a very big pattern, relatively speaking. It was also interesting on this one that's on the chart here, this larger one here. It's very interesting that the volume built up before the breakout, and it also was a clue that this trend was breaking to the north side, and it created what we would call an exhaustion pattern. The exhaustion patterns is basically when you have high volume going into the end of a move, like we have right here, you're still going to usually get one exhaustion move up. We did get that. We got a stair step here. And then the last one here, take a look at this. We got volume that's declining here as the next level of the stair step is continuing. Okay, so that was on CMG. Come on over here to what chart is this? This is on the spiders. I've marked a couple on this chart. This first one you've got here after the reversal was a little flag pattern. And interestingly enough, the volume came in on the last day that fit inside the flag, but it was the big bullish day in the flag. So yes, the volume came, it was up volume. It was volume that came in with the bullish move. The next day, which was technically outside of the flag, was actually a little doji candlestick, which we'll talk about in the next class. But that little doji candlestick was the first one that actually popped out. Traded bullish for 2 days, and look at this. We got a little 3-day flag, or 3-day stair step. You can see the volume implications of this right here. You can see that for 3 days of the stair step, we traded down volume, and then on that 4th day, the day that we broke out, volume came back in. And then we continued up a few days in the trend. Then we got into a larger stair step again, and right here at the end of the stair step, look at how the volume really fell down substantially. And this was another interesting kind of an anomaly. The first 2 days breaking out of the stair step, we did not have higher volume. So that's why, I always say volume, that's typical, is you'd have the increased volume. Is it required? It's not required. And just because you don't see it doesn't mean it's not the pattern. It's just, it didn't happen. But typically speaking, we would have higher volume there. And so there's a couple more examples of stair steps and flags all in one chart. Let's come on over and take a look at a bearish one here. This is on Foster Wheeler. And notice this particular trade here. We had our reversal. We started to trade down here. Then we stopped. We just stopped while the trade was consolidating. It was a very short term. We got exactly 7 days here. No, I think I missed a day. 8 days here in the pattern. And then on the 9th day, what happened? It started to break out. Volume returned. You can see the volume really contracted substantially during that 8-day period. Volume increased on the breakdown. We broke on down here. We had a quick retracement, and then we flatlined again, creating yet another stair step. This one actually broke out bullish and immediately reversed. In the next class, you'll learn that is a reversal candlestick formation there. That suggested that the stair step was going to continue bearish, which it did for a few more points here. And then, of course, the bottoming formation came in. We got our double bottom. And then as the thing started to reverse, look here. There's a little flag pattern, broke out. Here's another pennant, which we're going to talk about in a second. And then we got into a stair step yet again where volume was contracting. Okay, so there's another interesting formation there. Double bottom, little brief flag, another little continuation pattern, and then the stair step that you see on the chart there. Okay, so any questions about stair step? Somebody actually challenged me a couple days ago. They said, "Are you going to get rid of the stair step because they don't happen that often?" And I said, "Are you kidding me?" They said they happen all the time. But apparently, the way that I had shown them in the legacy class, people thought that they were rare. They're really not rare at all. They happen quite frequently, and they're quite reliable. Just very, very reliable, in my opinion, in terms of good continuation patterns. Now, the next pattern we're going to talk about is the final. It's kind of the three patterns work together. This is called the pennant. They're all variations of the flag pattern. This is going to occur in a strong trend with a sharp move, similar to the flag, but it's going to have a short-term support and resistance that are collapsing, very much like a small triangle. So you can look at this picture here. You see we're running up very sharply. We got the collapsing, or maybe converging would be a better term, little lines there, and then it breaks out in the continuation. Now, here's a really cool thing about the pennant, and one of the reasons I really like pennant patterns, one of my favorites, is because the pennant, the tighter the pattern is forming, the sooner you know it's coming. And now, how do you know that? Well, you can only trade so tight into a wedge before, or into a triangle before it's going to break out. And so the pennant is just like a baby triangle. You can only get into that little apex so far before you've got to go one way or the other. Again, with the pennant, volume tends to decrease on the during the pattern itself and increase on the breakout of the pattern. Take an expanded look here of this particular formation. What I was trying to explain is you can only get these lines to go so tight. Maybe they came all the way over here, but there comes a point where you can't get any tighter in here. And it's just got to go one way or the other. When that happens, it's like clockwork. Once it breaks out, it tends to go. And extremely consistent pattern. And so that's one of the reasons I really like the pennants, because once it breaks, once you get in that really tight corner, you can only stay there so long. And then it's going to go. It's going to break one direction or the other. Usually, more often than not, it will break as a continuation. Here's what it would look like as a bear pattern. We would call it a bearish pennant pattern. I still refer to them all as pennants, but if you want to be really technical, it would be a bearish pennant version, or a bearish pennant pattern. All right. Continuing on here, take a look at some pennants in application here. This is on American Express. Notice the pennant right in through here. You see this particular one kind of had a flat bottom and then it broke out. But the volume requirements worked pretty much the same. Small contraction of volume, then volume broke out there on the breakout of the pennant. And I've actually got another flag pattern happened right up in through here. You can see that little flag there. This was a flag that was forming at the time of the screenshot. I didn't mark them all on the chart, but you can see it there. But the pennant, that's what I wanted you to see. You see how the lines are, it's hard to even say lines because it's so small. You can't sit here and say, oh, all these little support and resistance. No, it's just kind of, I'm just going to draw a little line connecting those little formations. It creates this little baby triangle that creates the pennant. Does that make sense? You guys see how that works there? All right, let's take a look at this particular pennant over here. I've got a bullish one and a bearish one on the same chart. This is for Garmin. Notice this little pennant right in through here. So we're just kind of converging in through here. And then once it gets into the little peak, it's like, well, that's the best I can do. It's going to bust out one way or the other. Then we had a little flag pattern right here. Uh-oh, come back. Come back. Had a little flag pattern right in through there. Had a gap up here, which we'll talk about gaps later tonight. On the way back down, look at this little pennant that formed right over through here. And so you guys get the idea of what pennants look like. You could probably classify this one as a stair step that I just wrote out here. And so the interesting thing about these little patterns is they're the formations that stocks tend to do. Formations that stocks tend to do while they're working through the trend. So you're going to have a thrust of energy, a little reset or a little resting motion. A lot of times in Power Trader, you'll hear me refer to, I'll say something like the stock needs to rest for a moment. And that's kind of the things that I'm talking about. A little small short-term continuation pattern could be a rest. A little small retracement could be a rest. Any of those kind of things could be good little rests that would give you the opportunity to catch up and catch the momentum. All right. Now, let's talk about the wedge. And let me just skim through your commentary. Is there any questions about pennants or flags or stair steps? I see a couple people saying that there's no pennant in the notebook. I believe you because more than one person has said it. So I'm going to check on that as soon as class is done, and we'll find out why it's not in the notebook. It should have been in the notebook. I'm sure it somehow just, I don't know how it got overlooked, but obviously it did. So we'll get that resolved and have an updated notebook for you. Any other questions about pennants or flags or stair steps? Barry says the cup and handle is the most popular pattern in the investor's business daily world. It is, Barry, and the cup and handle actually is more of a formation than it is a pattern. It's more of an event. And it's not a pattern that I really deal with a whole lot, partly because it's not that consistent. I know IBD really deals with it a lot and they love it, but it's not one that I deal a whole lot with. So that's another discussion, Barry. But thanks for pointing it out. All right. Robert, those notebooks will probably be updated before midnight because Paul's actually here tonight, and so I'll deal with him between classes, and I'll deal with Paul. No, that's not what I mean, but I'll tell Paul about it, and we'll figure it all out. All right, let's talk about wedge patterns. There's two types of wedges, and of all the patterns, the pennants, the wedges, and the triangles are the ones that are most confusing to people. And I wish they weren't confusing. They're all distinctly different, and they are similar. They're confusing because you've got a support and a resistance that are converging upon themselves. That's why they become confusing. But the size is the big difference. And so before you ask me and make a big deal that you're confused because you can't figure out the difference in pennants and wedges and triangles, I'll tell you the big difference is size. Triangles, as we talked about in the last class, very large patterns, 2 or 3 months usually, 4 months sometimes. Very large patterns are big consolidation patterns. Pennants, as we just talked about, very, very small. They take 3 to 8 days, maybe 10 days to form, and then once they're done forming, they're done, and they break out. Okay, so you're looking at months to form versus days to form. The wedge, wedges are somewhere in the middle. They tend to be a little bit bigger than pennants. They're definitely do not have the same kind of formation as a triangle, though. And in the examples you're going to see here, you'll notice how different they are. Wedges tend to be a few weeks. They could be a couple weeks. They could be 3 or 4 weeks. I've seen some large wedges. Usually they're not that big, but there's still some wedges in there, or there's still some time in there. So we'll see that in just a moment. But I really want you guys to make a clear note. The difference in pennants, wedges, and triangles in all the cases are number one, function, and number two, size. Size is the big difference. All right, so let's look at these wedges. There's two types of wedges. There's what we refer to as a declining wedge, or sometimes you'll hear us refer to it as a falling wedge, and then there's what we call a rising wedge. And interestingly enough, the wedges tend to play out the opposite of the name. Okay, so we'll look at that in just a second here, but they tend to play out in the opposite of their name. The patterns are interesting because they don't just occur in trends. They occur kind of everywhere. Triangles tend to occur at the end of a move, seeing as they're a consolidation pattern. So you'll have a big move into the triangle typically, but it could break either direction, bullish or bearish. The pennants are part of a move. They become a continuation pattern. Wedges, they can happen in a trend. They can continue the trend. They can happen at the end of a trend. They can reverse the trend. They're really kind of a jack of all patterns in terms of function. The reason we want to identify them is because it's the formation. Once you see the formation, you can identify the breakout. The way it breaks is the practical aspect for us. And wedges are very consistent with the way that they break, which we'll look at here in just a moment. So they're kind of interesting again because the locations are kind of all over the place. Technically, they are a form of consolidation. And the breakouts are so predictable that we tend to call them continuation patterns. We call them continuations really because we don't know what else to call them. They're not consolidations. They're not reversals. Depending on their location, though, they can act as any of the patterns. So it's kind of a funky classification here. I always wrap them in with continuation patterns. Like I've already mentioned, they're similar to the triangle, but they are substantially smaller, though not as small as a pennant. You have the two lines that are collapsing in on themselves. Here's one of the distinctions. Both of the lines are moving at an angle, and that angle is in the same direction. Okay? Take a look at how these lines are drawn on the screen here. Notice that the top line is moving uphill and the bottom line is moving uphill but they are still converging upon themselves. And if you drew these lines out far enough, they will connect at some point, even though they're both going uphill. Okay, so you see that distinction? That is one of the distinctions of a wedge pattern. It's forming a wedge. Usually, that move is counter trend, but not always. But usually it's counter trend. The lines in the wedge are going to meet somewhere in the future, usually way out in the future, usually like 2 or 3 weeks after the wedge ends up breaking. That's where the actual lines would converge and meet. You contrast that with a triangle. Triangle is almost always, technically because of the size of a triangle, they would meet in the future, but you're getting into the apex of the triangle before they break typically. Same thing with the pennant, and very often you actually are breaking at the convergence of those two lines. Whereas with a wedge, they can really extend quite a ways out sometimes, which we'll look at in our examples in just a moment here. Again, take a look at this picture here. Both lines are moving the same direction while collapsing on each other. Both of these pictures here. Notice that this line is going downhill. This line is going downhill, but they're still collapsing. Does that make sense to you guys? I don't know how to explain it any other way. They're converging, but they're going in the same direction. All right. The rising wedge is that one that we just looked at, that I just drew a picture of for you. And in the case of the rising wedge, the stock is moving upward. Well, I say it's moving upward. The lines are moving upward, so obviously the stock is moving upwards. Technically, the stock is going back and forth in the middle there, but the lines are moving upward there. You get a small triangular formation. Both the support and the resistance are higher, moving higher. And the support is rising at a faster rate than the resistance. Okay, so that's the only way that it can form, actually. The resistance is rising, it's going uphill, but the support is bringing all this pressure up here. Now, based on that formation, which direction do you think the trend would break? Which way do you think it would break? You would think, based on the rising support, you would think it would break bullish. However, the majority of the time it breaks bearish. The rising wedge is a bearish pattern, interestingly enough. Okay, and I've quoted a statistic in here. 69% of the time, according to Thomas Bulkowski. Now, who's this Bulkowski figure? Thomas Bulkowski is a technician who has done a lot of research on chart patterns, and he's got a book called The Encyclopedia of Chart Patterns, where he quotes this statistic. I am actually not that bullish on Bulkowski because I don't agree with all of his findings. Everybody in the world of technical analysis always references Bulkowski's research. I find that his research is not always that accurate, but oftentimes it is substantial enough that it supports what we already know. In the case of the wedges, it does support this statistic. I didn't pull out the exact statistics for flags and pennants and stair steps, but those guys, they're like in the high 80s, 90%, I think, of how consistent they are for playing out as a continuation. Just very, very accurate. But these rising wedge patterns, about 70% of the time, almost 69% of the time, they break out to the bearish side. So that's really good to know. If you're trying to be consistent 70% of the time and you just did nothing but find rising wedges, statistically speaking, about 69% of your trades would turn into winning trades in terms of picking a direction if you just played the rising wedge. All right, now, we've already looked at that picture enough. We'll skip forward here. Take a look, couple of examples of rising wedges. I already told you, sometimes they are part of a trend. Sometimes they're kind of a reversal here. This particular one on CVX, it came right after the reversal. You see that here, and you see it's really, really small. There's no way you could trade inside that. It's not like a triangle. A triangle would be very large. It would be something like this, where the lines are converging, but it's very large over 2 or 3, 4 months here. This little wedge, it's much smaller compared to the triangle, but it's much bigger compared to a pennant. In fact, I can draw a pennant pattern on here. Here's a little pennant right here. So you can see that would be a pennant. This is the wedge. And this is a rising wedge because The bottom line in particular is rising. The top line, in this particular case, is not really rising that much. Normally, you would say it's rising, but relatively speaking, it's a rising wedge. You see how far out the lines would connect. That convergence is way out in the future. You see that there? And so that's the distinction between the wedges and the triangles and whatnot. These wedges would actually cross a month into the future from where they actually did break down here. Now again, you compare that with this little pennant that I drew out. You know, you're breaking right there where they converge and where they connect. Does that make sense? Is this becoming a little bit clearer, more clear to you guys? Okay. Now continuing on through this move, we had a move here in August where we had the same formation. Notice that these lines, both of them are going uphill. Again, they would converge way in the future, and it broke out to the bearish side. It's a rising wedge that breaks bearish. Now, I saw someone say, what does counter trend mean? Well, this trend in this case is going down. This wedge is going up. It's going counter to the trend. Does that make sense? So the trend is going bearish. The wedge is going counter trend. It's going against that trend there. Okay, so there's an example of a rising wedge. Now here's another rising wedge. This one happened on Google. And this one did not occur during the trend. It was actually the end of the trend. See the gap? We closed up after an earnings announcement, and we ended up with this wedge formation. But here's the cool thing about it. Even though it was the end of the trend, we could tell which way this was likely to break because it was which type of a wedge. It was a rising wedge. And rising wedges, more often than not, tend to break bearish. Okay, does that make sense? So again, the location doesn't matter nearly as much as the type of wedge. Is it a rising or falling? If it's a rising wedge, it tends to break bearish. Now, the falling wedge is the opposite. The stock is moving downward inside that formation. You're going to have a small triangular formation. Both support and resistance are lower, and the resistance is falling at a faster rate than the support. Take a look at this picture here. You see that the resistance is coming down much faster than support, but support is coming down. Again, the picture would indicate that that bearish pressure from the top should suggest a bearish breakdown, but that's actually not what typically happens. Instead, what we typically have is the opposite, where it actually breaks bullish. A falling wedge tends to break bullish. In fact, it's so consistent that Bukowski found that it's 92% of the time. So that is a very, very consistent pattern, and you guys can see why that would be valuable to learn how to identify. Come on over here and take a look at some of these falling wedges. Here's a falling wedge in the dollar index. Notice how, again, the lines are, both of them moving down, but the top is moving down much, much faster. That's a it's a falling wedge, setting us up for a bullish move right there that you saw. And then look at the end of the pattern here. What's that formation? There's a flag. You see how stinking consistent these patterns are and how frequent they are? These little guys are just everywhere, these flag patterns and these pennants and everything. All right. Now, let's just give you some final thoughts here on continuation patterns. Continuation patterns are patterns that are short-term patterns which indicate continued movement in the trend. And these particular patterns are some of the most predictable and reliable patterns that you're going to find in the market. Continuation patterns are really great. That's why so many people love them. If you really want the statistics, you can look up the Encyclopedia Chart Patterns. I don't care. It's a big book. It's a fairly expensive book. It's about $100 for the book. I think you might get a little cheaper on Amazon, but it's not really that cheap of a book. It's really a reference. You probably don't want to take it into the bathroom for reading material. You might want to, I don't know. But it's kind of a boring book. But, for those of you who are into statistics, there's a reference for you of a book. All right. Now, let's transition the evening here, and let's start talking about gaps. And gaps are an interesting subject. Interesting subject that are highly misunderstood by a lot of people. And there's actually a very interesting theory and study that goes along with the study of gaps. To start the discussion, what is a gap? That's what I'll start with, is asking you the question, what is a gap? And the answer is it's when the opening price of a stock does not match the previous day's close. When the opening price does not match the previous day's close, it creates a gap in pricing. A lot of times you actually hear the word vacuum associated with it because, as this picture suggests over here, we closed one day at this price right here. We opened the next day way up here, and there's a vacuum. There's a void in here where no trading took place. And that's awkward. That's not normal. Normally, if you look at the typical chart will fill all those spaces. So more often than not, you have a consistency. But when you can look at a chart and you see a gap, it means something happened there to create that gap. And that sudden creation of a gap is going to indicate something. Usually it's some type of a continuation, interestingly enough, though not always, as you're about to find out. All right, so what in the world could cause one of these special events that we refer to as a gap? Well, number one, it's a sudden change in perceived value. Remember a couple of classes ago, we talked about what is the value of a stock, and the value is what people are willing to pay for it. And then I asked the question of what causes a stock's price to move, and we answered that question with the perception or the opinion of the public. And as the public changes their perception, they drive the price of the stock. So what could suddenly cause a stock to gap here? Well, the answer is a sudden change in that perception, sudden change in that perceived value of the stock, okay? Usually what's going to happen is that's going to happen overnight. Since the market is closed and then new events come out, that's going to change the perception overnight, and then the next morning when the market opens, all these buyers or all these sellers show up and they drive the price suddenly really, really fast. And of course, the market maker's out there trying to make a market and match the buyers and sellers, and you end up with this gap in pricing. Now, there's several things that could cause it, several events that could occur. After hours trading, sometimes after hours news, very, very often. This is most of the time what happens. Sometimes you can have a sudden emotion of desperation. It could be a desperation of fear.